I'm Andrew Ness, co-manager of TEMIT, and I'm delighted to join you from our Edinburgh office on this beautiful spring day. For those of us in the UK, it's a delight to finally see some sunshine and feel some heat. Unfortunately, emerging markets have also felt the heat over the last 12 months, a challenging combination of rising inflation and interest rate hikes, the ongoing Russian invasion of Ukraine, and supply chain challenges have weighed on both economic activity and investor sentiment. However, several bright spots have emerged in recent months: signs of receding inflation, policy support for domestic consumption, and China's pivot away from zero COVID have started to restore investor confidence and markets have stabilised. By region, emerging markets in Asia have fared better than their peers in Latin America and emerging European, Middle East and African markets. However, all three regions witnessed a decline over the last year. Stocks in China initially contributed to regional gains after the dismantling of the country's zero COVID policy and new measures to spur the economy, such as support for the property sector. However, the market has subsequently sold off in recent months on the disappointing reopening and ongoing US-Chinese tensions. Weakening global demand for consumer electronics, meanwhile, weighed on tech-heavy markets in South Korea and Taiwan, and the Indian market corrected following its previous strong performance. Latin America was dragged down by the emergence of political concerns, which weighed on currencies and markets. Emerging European markets, meanwhile, lost ground on the fallout from Russia's invasion of Ukraine and the dislocation in regional energy markets. Towards the end of the period, share prices in the Middle East, which had been through a boom, declined as oil prices moderated and liquidity conditions tightened in some of the markets. So overall, a challenging backdrop for us to navigate through. However, the good news is that we managed to do just that, and over the last 12 months to the end of March, we've both outperformed the MSCI index and generated a small positive absolute return for our clients. And that's due to our investment approach that has remained true to our beliefs, seeking sustainable earnings at a discount to intrinsic worth. This means TEMIT's portfolio characteristics have been consistent for some time, thus allowing us to navigate the challenging market environment out there. For example, high returns on capital and lower leverage characteristics of the portfolio should be able to weather inflationary pressures via better margins and lower interest payments. Also, lower valuation characteristics of the portfolio should make it less exposed to valuation compression from rising rates versus more expensive, long-duration, growth-oriented names. In addition, a significant number of our companies are offering attractive dividend yields and many are buying back shares, and this provides additional support to the portfolio. Looking forward, we still have confidence in both the asset class and in our portfolio, and that's because of the attractive characteristics of the companies we own. We remain positioned in the long-term themes including consumption, premiumization, digitalization, healthcare and technology. We focus on companies reflecting our philosophy of owning good quality businesses with long-term sustainable earnings power and share prices at a discount to intrinsic worth. We see high levels of leverage as a risk, and we continue to avoid companies with weak balance sheets.